a lot of people may have been scared out of the market who recently got in. Maybe other people were motivated to take profits, hearing all of the talk of a bubble, and the bubble's popped and the market's going to go down. But I think the volatility makes sense given the move that preceded it. I think it's a huge breakout in silver. I think silver prices are headed substantially higher from here. I think a lot of this volatility will ultimately, go away. And I think we'll see a far more orderly appreciation of silver, maybe something more similar to what was going on with gold up until the recent volatility. And I think the bull market in gold is going to persist.
Since silver exploded to extreme highs and then violently pulled back toward the $70 to $80 zone, what looked like a collapse on the surface was actually the confirmation of a structural reset that permanently changed the price floor. Peter Schiff explains that when a metal breaks out of decades-long suppression and enters a new range, corrections are not signs of failure, but evidence that the market is transitioning into a higher valuation regime. Silver falling from panic-driven peaks does not erase the breakout. It proves that prices have already escaped the old system, where $20 to $30 once defined the ceiling, and entered a new era where even $70 becomes a stabilization level instead of a top. At the same time, gold holding near $4,800 to $5,000 reveals something far more powerful unfolding beneath the surface. This level was once viewed as an extreme prediction, yet it has now become a consolidation zone where global capital is quietly repositioning. Schiff emphasizes that gold remaining within striking distance of its highs, despite aggressive selling pressure and volatility, signals underlying demand that has not weakened. Corrections at these levels are not driven by collapsing fundamentals, but by temporary liquidity shifts, while the larger force driving gold higher, currency debasement and loss of purchasing power, continues accelerating without interruption. Silver's pullbacks toward the high 60s or low 70s are not reversing the trend but strengthening its foundation. Physical demand continues tightening supply chains, while futures markets attempt to suppress the true extent of scarcity. Schiff warns that this disconnect between paper pricing and physical availability cannot persist indefinitely, because real metal cannot be printed or created on demand. Once physical shortages intensify further, futures prices will be forced to rise rapidly to match reality, triggering a repricing phase that moves far beyond current expectations. What appears today as volatility is, in reality, the early phase of a much larger monetary transition. Gold stabilizing near $5,000 and silver holding multiples above its historic averages signals that the metals are no longer reacting to temporary speculation. They are responding to systemic pressure building inside the global financial structure. Schiff makes clear that once confidence in paper assets weakens further, metals will not climb slowly, but will revalue violently, transforming current price levels from seemingly expensive into levels that, in hindsight, were only the beginning of a much bigger move. Before we jump in, if you appreciate these deep dive market breakdowns, please take a moment to like the video and subscribe. It helps this analysis reach more people while it still matters. I'd love to hear from you in the comments.
Well, I mean, you can't look at that volatility without looking at what preceded it. So we had a spectacular rise in gold and silver. The gold rally really took place over a more extended period of time. Really, gold broke out in early 2024 and had a slow and steady rise to 4,000. Then it kind of had a very quick move from 4,000 to above 5,500. Silver really went nowhere as gold went from 2,000 to 4,000, and then finally moved from 3,000 to 120. And in fact, the move from 80 to 120 was like a few days. So I think once silver broke out above 50, that was both a psychological and a technical overhead resistance going all the way back to the Hunt brothers in 1980. So I think once that happened, a lot of money came into silver, came into gold, and silver obviously got ahead of itself. The exchanges came in several rounds of, margin hikes. And I think some of the speculators got caught and there was, a lot of volatility. People got forced out of positions. A lot of weaker longs might have bailed out. You saw the media talking about a silver bubble, which, bubbles don't form over a matter of days or weeks. It's something that forms over a much longer period of time than that. But I think a lot of people may have been scared out of the market who recently got in. Maybe other people were motivated to take profits, hearing all of the talk of a bubble and the bubble's popped and the market's going to go down. But I think the volatility makes sense given the move that preceded it. I think it's a huge breakout in silver. I think silver prices are headed substantially higher from here. I think a lot of this volatility will ultimately, go away. And I think we'll see a far more orderly appreciation of silver, maybe something more similar to what was going on with gold up until the recent volatility. And I think the bull market in gold is going to persist. Gold is only about 10% off its highs. So, nothing like silver down 30, 40% from its highs. So it's just a normal correction in the silver in the gold bull market. But I think what happened in silver is a very rare event, but it coincides with something that was also rare, which was this massive breakout in silver. So I think it's very bullish for the metals and even more so for the miners. I think the precious metals mining companies are even cheaper. And Wall Street is still not woken up to that reality either. Obviously, gold is under accumulation in the East, and the selling has been coming from the West. And I think the East has it right. I think China is correct that buying gold is the right thing to do and that the price is going to go higher. To the extent there are speculators in the U.S. that don't get this and that want to short gold and silver or who want to sell the gold and silver they have because they think it's some kind of a bubble, I think they've got it wrong. And I think the buyers have a lot more dollars that they need to convert into gold and silver than the speculators can short as far as their ability to short and sell gold and silver that they don't own and have no ability to deliver.
Absolutely. No, it makes sense. And we've seen that trend, for a number of months now. 15 months of Chinese central bank buying, for example, is a constant reminder.
Well, it's not just Chinese central banks. There's a lot of other central banks that are buying. And there's private demand that is growing, not just around the world, but you're now starting to see some private demand in the U.S. So it's picking up all over the world.
A powerful shift has already taken hold inside the precious metals market, and its consequences are far more explosive than surface price charts suggest. With gold holding near the $4,800 to $5,000 range, while oil remains close to $60, the entire economic equation of mining has been turned upside down. Energy, which once acted as a limiting factor on profitability, has remained relatively contained even as metal prices surged into a completely different valuation zone. This disconnect has created an extraordinary window where production costs reflect the past, but revenues reflect a radically revalued financial reality. The result is a silent profit expansion that is building pressure beneath the surface, waiting for broader capital to fully recognize what has already changed. Peter Schiff explains that silver trading between $70 and $80 has intensified this transformation, reinforcing profit margins and strengthening the financial position of producers across the sector. Infrastructure, labor, and operational systems were built for a much lower pricing era, yet they are now generating returns tied to historically elevated metal values. This widening gap between cost structures and selling prices is creating a powerful imbalance that markets have not fully priced in. Once institutional capital fully absorbs the scale of this profit expansion, the repricing of mining assets could accelerate rapidly, marking the beginning of a phase where the true financial impact of gold and silver's revaluation becomes impossible to contain.
Buying gold anywhere below or close to 5,000, I think still makes sense. I don't think there's significant downside risk. To me, gold is acting around 5,000 the way it acted around 4,000, the way it acted around 3,000. But also buying gold at 5,000, you're getting it 10% below its high. So that is a decent correction. Does it mean it can't go to 4,900 or 4,800 or 4,750? No, it doesn't mean that. But who cares, right? If you're buying gold as a long-term store of value, it doesn't matter if after you buy it, it gets a couple of $100 an ounce cheaper. In fact, you could always buy more. As far as silver, I expect more volatility. So silver, as we're talking, is just below 76. Yes, it could easily fall below 70, and so you'd be down close to 10% on paper if you bought some here. But again, I wouldn't worry about it. I don't think silver's going back down below 50. In fact, I don't even think it's going to get anywhere near 50. So I think we're not that far. Maybe the upper 60s or, low 70s is maybe about as cheap as you can get it. But the other problem you have is that physical silver is getting harder to procure. So the premiums that people are paying now on silver coins and bars, especially low denomination, are higher. So even if silver goes down $10, it doesn't mean you'll be able to buy it $10 cheaper if you actually want physical. So you've got two things working there. You've got, the scarcity of the physical metal. Yeah, if you want to buy a futures contract, you may be able to buy it, but buying a futures contract is not the same as getting metal delivered to your door, which is what we're doing at Schiff Gold. So I just tell people, just buy whatever we got while we have it in stock, because I can tell by what's happening in the market that we're going to run out at some point. It's going to be hard to get silver, real silver, because I think there's been a big disconnect between the paper market and the real market. And eventually that's going to resolve itself with the futures moving higher. But in the short run, the futures price could do whatever it's going to do, but the physical market is limited by the actual supply of deliverable silver and the demand for that silver, which is growing, not just by investors, but by industry that needs silver. So if you're making batteries and the batteries need silver, you can't just buy a silver contract. You can't put the contract into your battery. You got to actually have real silver delivered to you. So you have to buy it in a physical market. I mean, there's a constraint on how much silver can come out of a mine. There's only so much the mines can produce. They just can't turn on a new mine just because silver is higher in price. They just can't say, oh, let's mine more silver. Most of these miners were already mining as much silver as they could at the older prices, but also has to do with the refiners. If they run out of inventory, they can't magically transfer bullion into coins and bars, the raw silver. So if all of a sudden there's a big increase in demand by investors, they just don't have the capacity to immediately supply it all. So you get a backlog and you get delays. So then obviously people will start to pay more money for a more immediate delivery of their metals. So all these things are happening. I mean, I can tell you at Schiff Gold, business was very slow for the last several years. It just picked up a lot in the last month to the point that we've never been this busy. But to go from a very slow, environment to all of a sudden busy, well, you don't have the manpower. You don't have the resources. You're not used to it. All of a sudden there's a big increase. And that's not unique to my company. Obviously, it's happening all over the industry. So, yeah, we've hired some more people. We're ramping up to deal with it. But, there's going to be problems throughout the entire distribution channel when all of a sudden there's a lot more demand for the metal. Inflation, de-dollarization, which is a function of a loss of confidence in the U.S. in its ability to honestly repay its debts, in the independence of the Federal Reserve, in the Fed's commitment to maintain the dollar's value or fight inflation. I think, markets are coming to terms with the reality of, $38 trillion national debt rising, in perpetuity by 2, 3, 4, 5 trillion a year. Who knows? You've got Donald Trump wanting lower interest rates, putting pressure on the Fed to lower rates because we need lower rates, because we can't afford to pay the rates because we have so much debt. Donald Trump's main goal is to continue to inflate a bubble. He doesn't want asset prices to go down. He wants the stock market to keep going up. He wants the real estate market to keep going up. The only way to do that is by sacrificing the value of the dollar. And that's what they're doing. And so if we're sacrificing the value of the dollar, why does the world want to hold the dollars? The world doesn't want to be sacrificed. Foreign central banks don't want to hold a currency that's going to depreciate as a reserve. So foreign central banks are moving from dollars to gold. International investors are doing the same thing. And, Americans are going to be doing the same thing. It's going to be a mass exodus out of U.S. dollars into an alternative. And gold is the most viable monetary alternative. I mean, for banks, it's really the only alternative. Private citizens, yeah, they could buy stocks, they could buy real estate, they could buy other things, but gold and silver are going to be a big part of what investors buy when they want to get rid of their dollars. And that is going to continue. There's no end in sight to the deficit spending. The Republicans have no stomach to cut government spending. They refuse to do it. They may criticize deficit spending when the Democrats do it, but the minute they have control, they do the exact same thing. Look at the big, beautiful bill that the president brags about signing. They criticize all the spending under Biden and say that's why we had inflation under Biden. Yet when they had an opportunity to cut back on the Biden spending, they not only didn't do that, they preserved all that extra spending and then added to it with extra spending of their own. And then they cut taxes. So we have less revenue than Biden had, but we have more spending. So we're going to have bigger deficits under Trump than we had under Biden. And so the world can see this, and it's like, all right, well, we got to get out. And plus we've weaponized the dollar both under Biden and Trump. We use it, to bludgeon people with sanctions. And the world doesn't like this. And now, Trump is out there chastising the world, criticizing the world. We're entitled to low rates. You guys, and you're taking advantage of us. You're ripping us off. So we're going to put tariffs on everything. We're angering a lot of our allies. And then we're, threatening to invade them. Trump was talking about invading Greenland. He eventually backed down. But the fact that he even put that out there and suggested that it was something that we were considering, I mean, why the hell does the world want to subsidize that? If we've gone from being the protector of the world to being an aggressor to saying we can take whatever we want, if we think it's in our interest to invade your country, we're just going to invade it. I don't think that's something the world wants to subsidize. And that's what they do by holding dollars.
The gold and silver markets are entering a phase that few have truly grasped yet, and the moves ahead are likely to shock even seasoned investors. Gold is breaking through barriers that seemed insurmountable only months ago, propelled by relentless central bank buying and a surge in private demand. Physical metal is vanishing from the market at an alarming rate, leaving futures and paper contracts struggling to reflect reality. Every ounce removed from circulation tightens the squeeze, building a pressure cooker scenario that could push prices to levels the mainstream still refuses to imagine. This isn't just a rally, it's a structural reset in the metals market, and the consequences will be explosive. Silver is on the brink of a historic leap. Industrial demand is insatiable, while investors are snatching up every coin and bar available, driving premiums higher than most thought possible. Mines are maxed out. Supply chains are groaning under the weight of demand, and the disconnect between paper contracts and deliverable silver has never been wider. Margins for miners are exploding as the value of silver as a byproduct cuts costs dramatically, making each ounce mined far more profitable. Physical silver is no longer just a hedge. It's the ultimate weapon in a world where scarcity is turning into pure leverage. This isn't a slow grind. It's a surge that could redefine the global metals landscape. Prices that once seemed unreachable are suddenly on the table, with gold and silver positioned to move far higher than the public expects. private investors, savvy institutions, and even entire nations are shifting their holdings in anticipation, creating a tidal wave of demand that paper markets cannot contain. The question now is not whether the bull run will continue, it's how extreme the upside could get before reality catches up. How high could these metals truly go before the world finally wakes up to the magnitude of what's happening? Share your thoughts in the comments. Your perspective might help someone else see the bigger picture.